fundings are going on, of course, and got one that's sending everything secure and their site's not working for a builder, and it's like, oh my gosh. So we're still waiting on docs. I'm like, people.
Andy's just had 2 signings. Andy, were they in person or were they drive-by, or what were they?
Actually, one was with Diane, so she knows.
Yeah,
they
notary.
were actually Amy's still using the notary she always uses,
Okay.
and they went to the office, but they didn't want Diane nor I to go.
Right. Yeah, they're trying to keep it down to only the required signers type of thing, just to not have the excess people in the office.
Okay,
exposure.
well, that's, yeah.
But I've got other title companies that they're using notaries and going to the people's houses now, but they're not charging for the notary.
Oh, so they're charging for the mobile notary. Yeah.
Yeah, so they are not hitting the clients with that cost, but they want it to be out of the office just to kind of minimize any exposure and people coming in and out. Yeah. So, I mean, it's kind of crazy times, but at least, that worked. I had, literally 3 people signing last night, all within about a half hour each other. So I was just manning my phone in case there were questions.
Well, actually, that works out. You can probably do more signings because you just are in one place instead of having to go from place to place.
Exactly. Saves a lot of drive time and time there. So, I'm multitasking while, I'm waiting if there's any questions or calls. So it's kind of interesting. But,
What other changes are you seeing in how, how closings are going?
Well, so timing wise, it's interesting because of course they're having runners take the original doc packages back to our corporate office for funding, because we still have to have the original note in order to allow recording, right? So we've got, basically there's 3 people at the corporate office, the whole office, one being the receptionist, just taking inbound packages, and then, someone on the funding team doing the scans, for packages and so forth. So, it's very minimal there, but we're having a lot more on things like the appraisers, for what appraisal requirements are that Fannie and Freddie are allowing in certain circumstances, that the appraisers can do a drive-by situation, unless they're like cash out refinances or government loans. Government loans are still requiring that they do a full inside and interior exterior appraisal. But as this progresses, they're looking into what they're going to do on the Govy loans for that, because they know that that's also an exposure issue, not only for the appraiser, but for the families. If you've got elderly homeowners and the appraiser's going in, you can't risk that the appraiser infects them, so it's every day it's a moving target. So it's really kind of interesting. We just kind of move with the program and change whatever's needed. So
have you had any appraisers say that they're not going to go into a house yet?
Yes. Yeah. I've had some that just don't feel comfortable with it. And in that case, if it is one of the like government loans that requires an appraiser to go in, then they switch over to an appraiser that is willing to go into the property to do the inspection. On ones, I had one that originally was going to require a cash out refinance that was conventional, that was going to require an appraisal, even though loan to value was great. And I think Fannie Freddie is now tweaking what their requirements are. So literally, excuse me, when I ran it through the system again, we were able to get a property inspection waiver. So that was kind of interesting. So I think, from one week to the next, we're really seeing changes. And last week, daily, it was, a little on the stressful side, because every day you're like, well, all right. And it doesn't matter if the loan is already in play and certain things are going on with it. It's whatever the guideline is at the time that you're trying to close or get cleared for docs. So we're also seeing, like, on mortgage insurance, some of the mortgage insurance companies, they're supposed to be following with what Fannie Freddie is requiring or suggesting, right, for guidelines. And we're getting flags when we're ordering the mortgage insurance certificate at the end. You know, we have the quote, everything is good, order the certificate at the end, and you know, some are coming up with flags that, oh, debt ratio is too high, even though it's allowable and everything is fine, all by normal standards, and it's just that they're trying to now limit a little bit.
They're imposing their own conditions then on what they'll insure.
Exactly. So
Yeah.
they will have an overlay and may have other requirements that they are requesting, you know, to see if that's going to fly. So, you know, it's just one of those things that we're kind of day by day.
Yeah. I have a question about PMI on FHA loans. How does somebody with an FHA loan get their PMI removed when they have 20%, more than 20% equity in their home?
They need to refinance. That's the only way to get the mortgage insurance off at this point. So, yeah, in days prior to January, and I think it's 2 years ago now, they instituted with the mortgage insurance to be permanent. If you had an FHA loan prior, those rules under those loans were that it would fall off naturally at 78% loan to value.
Right.
So that could be removed and just drop off by natural.
Do you know what the date on that is 2 years ago?
It was January 1st.
So January 1st of 2018?
I believe 2018.
Okay.
Yeah.
Okay, good. And what about conventional loans?
So conventional loans, with those, we can call the servicer for that loan when it reaches an 80% loan to value. And what's going to happen is we let them know that we think that that's the case. They'll sometimes run it through a desktop underwriter to verify that they agree with that value and versus the loan amount. And if they agree, they will just drop the mortgage insurance off so that nobody has to refinance or do anything there. So there's, you know, that's a huge savings.
Yeah.
Sometimes if it's a close situation with conventional financing where they don't think it quite supports 80% loan to value or less, they may require an appraisal, which they will order, and the homeowner would be responsible for paying, you know, but still it's worth it, of course, for the cost of an appraisal.
Yeah, no kidding.
Remove that mortgage insurance because that's a huge savings monthly.
So one of the questions we've been getting asked a lot is what, you know, the Fed lowered interest rates to 0. So how does that affect mortgage interest rates?
Right. So everything is really uncharted territory in the respect of how the markets are responding right now to the Fed's adjustment in rates. And the reason is with the COVID-19, it's causing such market issues, not only within the States, but worldwide. So what happens is normally when the Feds reduce the rate, that interest rate, you know, at 0%, people assume that that is what they're getting for loan rates, which is not the case, of course. What that represents is what the institutions are borrowing money at from the Feds on a 24-hour period of time, right? So it's what they are borrowing funds for. So basically the Feds lowered that, helping the institutions be able to still lend money. Right. And then they can make some profit, obviously, on what they lend. It's just like buying a shirt in the store from the fabric to the manufacturer. You know, there's markups each step, so to speak. So with the Feds trying to keep the investors going and the institutions going and lending money and being willing to loan, they lowered those rates to help keep that market moving. Normally that would then adjust mortgage interest rates lower as well, because the institution is getting that rate at a reduced amount as well. But with the markets the way they're going now, there are other risk factors involved. So the investors, the lenders are pricing in those additional risk factors. And with COVID-19, You have risk factors that borrowers are not going to be paying their mortgage payments. You know, they're going to be asking for deferments. People are unemployed. They don't know the time frame that these, you know, deferments may go on, and they still have an obligation to pay the interest on the loans that they've got from the feds, right? So there's still money they have to put out. So basically what the investors are doing, rates actually jumped up from when the feds reduced those rates just because of what it's doing to the market with the COVID-19. And as we push dates out for the shelter in place orders, as those get pushed out, the investors are more concerned because of course there's longer periods of time that they may be without receiving payments from borrowers. So they're pricing riskier loans are higher priced. So those with lower scores, those with less assets, higher debt ratios, those are definitely pricing higher in because their risk factor is higher. And some of the investors are also putting in additional overlays to what the guidelines, the government regulations are. So for example, on FHA, normally, you know, you could go down to 585 on FHA loans, and on certain, you know, programs that they were looking for, they moved them from 640 credit scores to 660 now on FHA for certain down payment assistance and some other programs. So they are moving that benchmark up, basically saying they don't want those riskier loans, right? If they are going to have them and it still runs in the system at the lower scores, they're just pricing them. So for the first time in all the years that I've been doing lending, some FHA loans were actually pricing at a higher interest rate than conventional, which is, unheard of. And the reason is because those factors that I mentioned with credit scores, debt ratios, because FHA allows for higher debt, but those also then impose that additional layer of risk to the investor. So the investors are now basically having a pushback in a sense where they're going to make sure that they can recover, you know, any loss if there's going to be deferments or, you know, loss of jobs, because of course at higher debt ratios, there's more propensity for that person to not be able to continue making a mortgage payment, you know, with their higher debt factor. So they're seeing a lot of those situations in interest rates and pricing. So a lot right now for the refinances are not something that work for everyone at the moment. So what we're doing is talking to some clients about getting in a position, and we're on hold in a sense until things calm down, because we want to wait till it's beneficial for them, right, for rates, because otherwise it doesn't make sense in some cases on the refinances depending on when they actually got their home.
So I was just watching a meeting from some housing and financial experts from around the country, and they were talking about pretty much what you were saying. And they were saying that they keep adding overlays to their risk because, you know, like you were saying, on credit scores and on debt ratios, that they were accepting that they're not going to be accepting for a period of time because of the risk. They were worried about that being a problem as people purchase about that.
Right. Well, I agree, because that's what I'm seeing when I'm looking at loans, even that I've had pre-approved people prior and worked up, you know, have their scenario with their particular credit scores, debt ratios, and so forth. And in pricing them when I pre-approved them maybe a month ago to even where it is now, it absolutely, there's a difference in what those rates look like for that particular person's scenario. Some actually have improved on the conventional side for those that have high credit scores, low debt ratios, where, you know, the loan to values, everything is great scenario. They want to, I hate to say cherry pick in a sense, but we know
they do.
We know they do. Exactly. They're rewarding, the good situations. So those are good. So those that have strong, still active jobs, and we'll talk about that too, because that's a whole nother part of this COVID-19. But those that still have active jobs receiving paychecks, good credit scores, loan to value and debt ratio, their rates had actually improved some from a month ago, let's say, for the people that were approved. Mm-hmm. For others that maybe had the tougher situations that were okay and acceptable a month ago or even 2 weeks ago, they're now getting tighter because of these overlays. And we see that it is a domino effect in a sense, where you'll have one investor that says, okay, now we've restricted, for example, there's no portfolio loans any longer, bank statement program loans, investor loans that are just based on debt servicing for property. Those portfolio loans have all been suspended. Mm-hmm. And the investors on those literally had a hard stop and just said, as of today, we are not doing them any longer. And there were people that were in contract. Fortunately, I didn't have any. I have cleared mine, but they were in contract and they just were not continuing and moving forward. So they were either on hold or would have to cancel. So it's unfortunate, but same thing with jumbo financing. Yeah. A lot of the investors have pulled back on doing any type of jumbo loan. So we have a couple that are out there and that are still offering jumbo loans, but they are requiring larger down payments, mm-hmm. For the jumbo financing. And of course, are particular on the credit scores, debt ratios, and so forth. They're very, they put their own overlay in on those to have reserves left over at a higher amount. Typically, you need 6 to 12 months reserves, for example, and now It's higher.
Yeah, I was talking to somebody in the office this morning about the difficulty of getting jumbo loans, that maybe that's going to improve the sales of houses that are just below that jumbo loan rate, which is what, 5 something?
Yeah, currently the conventional conforming loan limit for Clark County is $510,400. They always have to make it an uneven amount, but anything over that amount is considered jumbo for Clark County. Mm-hmm. So yes, I think what we're seeing, because you can purchase a property that normally would be in jumbo territory, and they might have to tweak a little more down payment just to get it to a conventional conforming loan limit and be under the less restrictive guidelines, so it makes sense, and still be under the down payment that they would have been required for the jumbo. So they can still buy that property, but it is definitely, I think, getting that middle range price point. You'll get more activity on that at this time if somebody needs to buy, because the jumbo financing is very limited.
Yeah. Alyssa, did you want to ask Diane? We're talking with Diane Corbin, who's our lender. Did you have a question for her?
A couple years ago, and I can't remember if I already asked you this, but I keep getting all these notices about options to refinance, and maybe I logged on late, so I missed some of that information, but just wanting to know what the benefits would be to that and what the process might be for us to go through that at this point, and kind of what your opinion is around that.
So for the refinances, we were chatting about that a little bit. Right now, a lot of the guidelines and investor overlays that they've added more restrictions to financing. So it really depends on where your particular rate is at currently, what the benefit is. If it benefits where you're at a loan to value where we can eliminate mortgage insurance, going from FHA to conventional, something like that. Sometimes that's going to be a benefit. If it is just an adjustment of looking for better rate, may not be the case right now. I expect that kind of after we get the city or state back in swing where people are going back to work, or, you know, there's, as he's sectioning people, the shelter in place order to be removed, I think that's going to then spark everybody to really be out there. They're going to make adjustments to rates that are going to be better, because then there's going to be a little calming that, okay, people are going to be back to work, receiving paychecks, won't need those deferments, you know, possibly. So I expect that we'll see better rates here, maybe depending on how long this lasts, maybe 30, 60 days, you know, after the shelter in place orders are over, because then you've got more people going back to work, and they'll get more of a sense of those that maybe there's not people getting laid off any longer, because right now there's concern that even somebody active, that company may have to still buckle down and lay people off. So it's more of a situation of being in a holding pattern, in a sense, to see that you can benefit the most. Because what you don't want to do is, unless it was ultimately necessary that you refinance, some people were trying to refinance to skip a payment, you know, on a mortgage, just to help. And the thing is, you know, I don't think that's the best strategy, because right now you're trading one for the other for a 30-day reprieve, so to speak, where maybe in 60 days we could refinance and have better interest rate to lower overall payment or change what that loan situation looks like. And the other thing is, I don't know if anybody has heard, but we had watched a mortgage meeting. We kind of did a conference call, and some realtors were actually out there advertising for buying a home right now and not having 12 mortgage payments for 12 months. So this is not what anybody wants to see, and you have to be very careful, obviously, if they're deferring that first payment.
Yeah.
The investors are also very concerned and talking about getting pushback on those, that they would have to buy back loans if people are deferring those payments right away, because you're not buying a house to defer your first payment. They're now putting disclosures in the documents that say, when you're buying, you know, during the COVID-19, that it isn't, you're not at a hardship, so that you're not looking to defer that right away, right? I mean, who knows what happens 6 months from now, but you can't go in with that mentality that you're going to defer payments. And secondly, until the loan is bought by Fannie Freddie, and if it is one that's bought by Fannie Freddie, which the government loans are not, so it's one of those that if it's owned by them, it sometimes takes months for them to purchase it from the secondary market. So it may not be available for deferment for a long period of time. So that's also another reason, obviously, to make sure clients, that you're not recommending to clients, obviously, for that kind of strategy to buy. No, I know. I mean, it's amazing, though. I hear stuff all the time. So the other part of that is on the deferment situation. I had a client that talked to his lender, and he truly has a situation that he needs a deferment. Their deferment was that he could defer for 90 days. And on the 4th month, he would be required to pay back all 3 payments plus his 4th payment that was due at that time.
Yeah, I think we've heard that.
Yes. Yeah. And, you know, so you have to really be careful on the advising, because people are blanketly telling them, oh, government has deferred the payments, you can defer 6 months, a year, but there are different options, you know, that investor gives for that deferment. And of course, in that case, that gentleman said, well, if I had the money to pay it in 90 days, I wouldn't be asking for a deferment now, right? So you just want to make sure, you know, and that's kind of one of those, talk to your lender, you know,
questions,
answers, you know, so that you don't get involved you know, answering something about the deferments in that case, because they are very restrictive to that particular investor, you know. So it's, you know, it's been a lot of movement in those, and at first they weren't going to offer, they were looking at different ways of deferment, but a lot of them are automatically moving a payment as well. I heard from a client that one of the investors literally just moved their payment. Instead of being due April 1st, they moved it to May 1st. So the other part of the deferment situation, or something to be cautious of if your clients ask you about whether it makes sense to do that or not, is the unknown that we don't know yet, that has not been determined, is how that investor is going to report it to the credit bureau. They're told they're not supposed to report it as late payments. However, it may be reported as a modification, in which case that will affect their ability to refinance for a year after they get that modification, or whatever time frame was done as part of that deferment agreement. So that can cause, you know, issues of delaying what their ultimate goal would be. You know, now certainly if they need the deferment, you know, they have to do what they have to do, you know. But some people that are still actively working, nothing's changed in their world, or even retirees, for example, that their Social Security pension, they're making the same amount of money, nothing has changed. So they can still make their payments, but, you know, they're being told, oh, you should defer, or they want to defer just because. It's really doing a disservice to them. And I don't think the investors are explaining necessarily, or those advising them are not explaining what the ramification can be.
Yeah, our messaging has been real clear about that.
Oh, good.
You can make the payment, make it.
Good.
There's no guarantee about anything. We have about 10 minutes left on the call, so I want to see if Alyssa or Charlotte have any other questions. Nope.
Can't hear anything?
Alyssa does.
No, that was my main question, and you answered it.
Okay, very good. One thing real quick, if I can just say, for the job situation right now, for those purchasing and getting loans, the employment verification is extremely cumbersome right now, and a lot of the situation becomes that we're letting our clients know, because the first comment is like, I've never had to do this before. Well, we've never had COVID-19 before either, so with a pandemic, but we are literally having to do initial verification of employment and getting the written in the beginning, which is typical standard, to verify income. And normally then pre-note verification of employment, a phone call to the employer, would be done before loan docs are drawn. Well, now it used to have to be done 10 days prior to docs going out. Now it has to be 3 days prior to docs going out, because of course job situations are changing so frequently. And they are verifying if there are employees that are on temporary leave status where they're getting paid. Some casino employees are, you know, one of the biggest for us, of course. So if they're on leave status where they're still getting paid through the shelter-in-place date, then we've got to get also a letter from their employer on letterhead that says when they're expected to return to work and that there's no difference in pay. So we've been able to do that with a lot of the casinos, but some casinos are going to be particular about that. So we are definitely chatting with those clients ahead of time and making sure we can get a supervisor, you know, acknowledgement that they're going to produce that letter for us when it comes time for closing and funding. So, so far that's probably the hardest situation, is just the employment, because somebody can be before they would be on leave and still getting paid, and that was fine. And now some are getting actually laid off,
right,
with the expectation of being returned to work, you know, after the shelter in place is over. So there's a difference.
And real quick, how do you view this as being different from what happened in 2008?
So in 2008, with the mortgage market crash, it was a lot determined by values, right? So when it hit the market, people were walking from properties because of value, not necessarily because of affordability. They just felt like they're not going to recoup their losses. And people were still working. This is such a domino effect with, one shutdown, then trailing down to the other companies and employees and so forth that are losing their income. So the problem is this is not price point or market based, but it's kind of going to put us into a recession at this point, just because you have so many companies that are going to end up going out of business. And it isn't a housing situation. It's, nationwide. It tracks through employers, all the businesses, and one thing cuts out another. We're all still working, so to speak, but as the other situations tighten up for people and they're losing jobs or whatnot, that kind of will affect us more here. So, as I'm sure you're seeing a little bit, it's marketing for those that are retired, that are on fixed incomes, those kind of people, veterans that all have their set incomes regardless, are still good marketing. And there are people that are still working in their businesses and jobs that don't have any issue. So.
Good. Well, I don't really have any other questions.
I'm good. A lot of what you said, Diane, was basically what they were saying. What I watched just a little while ago, they were actually saying that some places were even verifying employment before they funded.
Oh, absolutely.
Yeah.
Part of funding, and it's always been part of funding that they verify before they fund a loan that the person is working, but they're going to the degree in these situations of on temporary leave or, something like that they're verifying dates of return and things like that too, where before it was just you speak to a supervisor, yes, they're still working, okay, great, fund the loan, type of thing. So it's just a little more intricate in what they're asking and what they're doing.
So I have one last question. It's personal.
Yeah, no problem.
So I'm in a position right now where I could get the PMI off of my loan without refinancing, as far as I know, with the servicer.
Because you're conventional.
Yeah, conventional.
Yes.
And what you said about interest rates also was what I heard a couple of days ago on a webinar with Lawrence Yun, the chief economist with National Association of Realtors. He said the same thing. Wait a couple of months, interest rates are going to go down. Right. I would like to refi to get a lower interest rate too, but it sounds like it might be better right now to get rid of the PMI and then refi in a couple of months.
Exactly. Because save yourself the money now, by getting rid of the PMI, and just that will be a savings in your payment. And then when we see that rates have actually calmed down and got where they should be, because I think they're going to do a lot to spark the economy once everybody's back to work and the investors have more security in the fact that they know they're not going to end up with new deferments, that type of thing. I think then you're going to see the better rates, which then would be the time to refinance.
Okay.
Yeah.
Good. Thanks.
Yeah.
Thank you.
You're welcome. You're welcome.